So rapid versus slow versus should they do the balance sheet at all? There are a lot of variables up in the air for this Fed right now. How quickly do they need to move in your view?
Not very. I mean, they've said 1,000 times that they want interest rates to be the primary tool. Interest rates are the tool that sends a signal to the public that the balance sheet really doesn't. It grabs the front page of the media, and the balance sheet is a technicality that no one understands. So I don't really get this headlong rush on the part of some FOMC members, not all of them, but some of them seem very keen on diving into the balance sheet. And I just don't see the logic behind this. I mean, if they're really that worried about inflation, then they need to raise rates more quickly. The balance sheet pressure seems to me to be kind of arbitrary and internally driven just by sort of a free-floating anxiety about having such a big balance sheet. It's true, it's huge, but I don't think it should be the primary tool that they use to fight the current round of inflation. They can deal with the balance sheet later. Let
me go back to what Dave Zervo said yesterday, and he comes at this from a market point of view, not so much an academic one. And his point is they've done $5 trillion of quantitative easing. That has had a real effect on the economy, and that it would seem silly to leave it sitting out there without trying to run it back down. In other words, to reverse the easing effect, you have to run it back down in order for rate hikes to even have as much potency. What do you make of that liquidity argument?
Yeah, well, the liquidity argument will make a difference in markets. That's what I'm worried about, that the Fed would take it back too quickly and trigger an entirely unwanted and unnecessary crash in the stock market. See, the thing is that reversing the quantitative easing isn't going to take back the stimulus that was put in the hands of the private sector. So remember, the Fed printed the money to allow Treasury to send enormous stimulus checks and make other payments through unemployment benefits and various other things to households and to businesses. No one is proposing taking that money back. So the money that people saved that was created by the Fed that sat in their bank accounts isn't going to go away when the Fed reverses, or if the Fed reverses its balance sheet expansion. It's going to shrink bank reserves instead. So this is not the reversal of what was done to ameliorate the pandemic. That money is mostly still sat there and still unspent. The balance sheet maneuvering, to me, if they do it, is simply going to raise the risk of an unnecessary market event, which would then feed back into the real economy. And as they're doing it, the public won't understand what they're doing or why. That's why interest rates are so useful as a tool, because they send an unambiguous signal that everybody can understand. Oh, mortgage rates have gone up, credit card rates have gone up, car loan rates have gone up. That's very simple. Fed shrinks balance sheet. What does that mean to the average individual? Nothing. So if they want to get a grip of the economy, they need to do that.
I like this take, Ian. It's provocative. That's why we do a show. Let me ask you how many rate hikes then, if you can, very quickly. You know, Bank of America came out with 7. More people are in the 4 or 5 camp. Since you would like them to lean on this tool quite a bit, would you be up there in the higher end of that range?
I'm at 5. I think they do 3 at the next 3 meetings. It sends a powerful signal, and I think they can go a bit more slowly. I mean, right now the market's kind of in this competitive, how high can we forecast the Fed phase of the cycle, which is always where we get to at some point. We've got there right now. I think some of those expectations have to be dialed back a little bit, but they definitely need to tighten. Rates are, they're at 0, and inflation is, well, unfortunately heading to 7%. They've got to move. They're going to have to move quite quickly, but they don't need to keep going at a breakneck pace, indefinitely. They need to get a grip of things, and then I think they can be a bit more measured after that.
All right. It's a great debate. Ian, thanks for joining us with your perspective on it today.
Shepard Smith here. Thanks for watching CNBC on YouTube.